Of course, people raise that in bear markets too, but that was a form of capital that is quite expensive in a bear market. And then finally, being very smart with that. I think that was the big lesson from the previous cycle is people lean too heavy onto the debt side, whether that was asset-backed financing through ASICs or senior secured debt, other forms. People went too debt heavy. And when you add that much leverage to your capital structure, really exposes you on the Bitcoin volatility price and the ups and downs of mining economics.
Welcome, everybody, to a new episode of Bitcoin Equities Talks. Today, I'm with Ethan from Luxor. Can you please present yourself, Ethan, and tell us about your company?
Yeah, thank you so much for having me on. I'm excited to talk about mining today. So, quick background on myself. I started getting involved in the Bitcoin mining scene back in 2017. I approached it from two angles. One angle, I was currently working at Goldman Sachs, so I approached it from an institutional lens. Our investment banking division had some early mandates in the space, working with some of the ASIC manufacturers that were looking to go to public markets. And so got to see kind of the more institutional side of the industry. In parallel, also founded Luxor with a few co-founders. And so started to see it from kind of the early stage startup space. In 2019, left Goldman and started working on Luxor full time. That's right when my co-founders started joining too. And since that point, we've really developed the product suite that Luxor has offered. So at the time, we were running just a Bitcoin mining pool and altcoin mining pools. So providing a service to miners to consolidate their hash rate and increase the cadence and the frequency of their payouts. Since that time, we've expanded the Luxor business to involve a few different software and financial services verticals. And so we really see ourselves as a platform or a service provider to the industry. Today, we run a Bitcoin mining pool that's currently ranked number 6 globally. We mine roughly 4 to 5 Bitcoin blocks per day. We run custom firmware that you can install onto Bitmain machines that allow for things like overclocking and improved efficiency. And then we also have an ASIC trading desk. We do roughly 10 to 15 million in volume per month on the ASIC trading side. So buying and selling new and used ASICs across 30 different countries. And then finally, we have a Hashrate Derivatives vertical where we offer derivative contracts that miners can use to hedge forward cash flows, lock in revenue certainty, and then also allows traders to access this industry. So a lot there to unpack, but that's kind of quick overview on what we're
Yeah.
up to.
Okay. So just like for our audience that are not that familiar with the business model that you're describing, perhaps you can walk us through like what's a mining pool and how does it work, and all the other services that basically they're all services that you provide to mining companies. Like mining companies are your first and unique set of customers, I suppose.
Yeah, so I'll put on my historian hat for this segment. But in the first 2 years of Bitcoin mining, most of mining was done solo mining, which meant that you as a mining individual or a business, you would connect directly. You'd run your own Bitcoin node. You connect directly to the Bitcoin blockchain and try to win the block. By 2011, there were so many people competing in the mining space that it became very unlikely that you would find one of 144 blocks per day. And so if you were plugging in a GPU back then and spending money on both the capital expenditure as well as the electricity costs ongoing, there wasn't a ton of revenue certainty. It could be months before you found a block yourself. And so a company started what's called a mining pool, where basically miners would come together, they'd form a coalition, and they'd pool together their computing resources and then split the reward pro rata amongst them, depending on how much work they contributed. What this did was it increased the frequency that the miners got paid out and added more certainty to their payouts. Since 2011, there's been a lot of developments in the way mining pools interact with miners. Today, majority of mining pools in the space work on what's called a full paper share mechanism, FPPS for short. And the mining pool basically acts as a purchaser of hash rate from the miners. And so today we connect with about 3,000 mining companies globally that distribute their hash rate, their compute power to our pool. And we're paying them out consistent Bitcoin for every hash rate, every share that they submit to our pool. And so we're kind of acting as the stabilizer for them and the revenue source for them as they spend money on machines, electricity, and then we're paying them for the hash rate in which they produce from those machines.
Okay, so basically, to put it simple, it's like each Bitcoin miner on its own would be playing the lottery of putting his machine and trying to win the next block. And what you're doing is you're pulling together a lot of lottery players, and they can share the whole profit from all their computing power, because you get much higher chances of getting the block reward, basically, because you have a much higher hash rate or computing power in the network, right?
That's a great analogy. It's almost the same as a lottery ticket, where each machine produces a lottery ticket, so the chances you win the lottery are very low. And you want to make sure that you have some certainty in getting some type of payout. It doesn't need to be the full lottery, the full Bitcoin block of 6.25 BTC, but you do want some Bitcoin. And just to quantify this, there's, depending on your estimates of the machine breakdown on the network, there's roughly somewhere between 4.5 to 6.5 million machines that are currently securing the network. So there's 4.5 to 6.5 million machines, yet there's only 144 Bitcoin blocks found per day. So the chances that you find a block with a single machine over the lifetime of your hardware is very minimal. And so that's why it's very crucial that you pool together, you combine with a few percentage points of the network so that you can find blocks and consistently get paid for your work that you're putting in.
Okay, so actually, the lottery analogy is quite interesting in the sense that, contrary to the usual lottery, where the lottery issuer keeps 0.5% of the profit, here, like, everything goes back distributed to the people participating in securing the network, and they got rewarded for securing the network. So they have like an actual benefit from providing a service to secure the network, right?
That's correct. In this case, like in this analogy, the network is the one administering the lottery, and miners, represented by mining pools, are the ones submitting the lottery tickets to that system. There is no fee taken from the administration of that. In this case, the network. So, the full funds, which currently is the block subsidy plus transaction fees, gets distributed to the mining pool and then in turn to the miners.
Okay. Today, you're still a private company. And in our ETF, we have a lot of listed companies, but we haven't seen any listed mining pool. How come?
Yeah. So currently, there's actually one company called Bitmining, um, BTCM, I think, trade on the New York Stock Exchange. It was
Okay.
a Chinese lottery company called 500.com. It ended up buying a mining pool from Bitmain called BTC.com. So today there actually is one mining company that does have a pool out there. Reason I bring it up is it's quite interesting from an accounting perspective. You can see it's a much different profile than a mining company. Reason being is the mining pools, the way the accounting works is that they're going to report gross revenue as the total amount of Bitcoin equivalent mined through the pool. And then their cost of goods sold, their COGS, are the payouts to the miners. And so mining pools, from an accounting perspective, have a very high gross revenue, very high COGS, and then net revenue, I guess, is a better metric to look at for those companies. Something that I feel like the market hasn't fully realized for BTCM at this point. But I think your question there, why hasn't there been other mining pools publicly listed? Well, if you look at the breakdown of mining pools today, there's a few different kind of buckets that you could put them in. One is the kind of old guard Bitcoin mining companies that would constitute companies like Brains or F2 Pool or BTC.com that have been around for a very long time. They made a lot of money. They've mined 20, 30,000 Bitcoin blocks in their lifetime. Some pools have mined over 1 to 2 million Bitcoin through their pool. And those companies are extremely well funded. So they don't really need access to capital markets. I can't really comment on the access to liquidity for shareholders perspective, but from a capital perspective, they're well capitalized. The next wave of pools you saw came from financial institutions. We saw this kind of wave happen in China. Huobi, OKEX, and Binance all launched their own mining pools. All three of those exchanges, obviously, at the time, were doing very well capitalized. And so the pool was just one aspect of an ecosystem that they were building as part of their servicing and exchange products. I guess you could classify DCG's pool, which is Foundry pool, as in kind of the same category, coming out of a crypto native conglomerate that's very large in the space. Um, I think there will be mining pools that list publicly in the future. I think Luxor, has one path there as well. There definitely is some concerns, I guess, or challenges when you're looking to go public, which means you can go public by. We've all kind of seen firsthand the scrutiny of the SEC right now going public in the US in terms of looking at mining companies and trying to understand their business model. Mining pools are certainly one level higher in terms of complexity than a mining company for the regulators to wrap their heads around. So it will take some work educating regulators on mining pools, but I think in the next cycle, you will start to see maybe two or three mining pools be publicly listed with a much different profile than capex heavy miners.
So, I mean, I understand that historical players and financial institution backed players have the means and the funds necessary to run their pools. But I would suppose that they would need to go to the market to raise more capital to have a bigger market share. How capital intensive is it to run a mining pool?
So yeah, the capital intensiveness comes from the need to have liquidity to pay out your miners and weather periods of bad mining luck. Um, Going back to like let's use another analogy here. The mining pool almost acts as the dealer in a blackjack table, where they know over the long run, the blackjack dealer knows over the long run what their odds are. They know they're going to win 50 or 51% of the time. Um, but in the short term, there might be a lot of variance where the table might be hot and they might be down a lot of funds. Mining pools in the full paper share mechanism act in a very similar way. We guarantee the payouts for miners based on the expected value of their hash rate, which means that if we don't find enough blocks and we have bad mining luck over a period, our balance sheet could be down significantly. And so, to your question there, I think it's a prudent risk management and treasury management strategy for miners to have either funds locked up in their own balance sheet or access to an insurance provider that can at least cover over 100 Bitcoin blocks worth of bad luck streak. So that looks something like 700 BTC in liquidity and access to that Bitcoin in the cases of bad luck streak. And so some of those companies, like early on, accumulated that Bitcoin by being early, like, F2 pools of the world. Some of them leverage their parent company balance sheets like Binance and Foundry. And then others use insurance. So the capital intensity comes from having to access that capital. Over the long run, that fund hopefully shouldn't deplete. Your bad luck period should be netted out by your good luck periods, but you do need those access to those funds, which is why I think we haven't seen a lot of new mining pools launch recently, because a lot of mining pools have trouble getting through that challenge.
So basically, when the miner plugs to a mining pool, he gets the rewards whether the pool actually wins them or not. That's what you're saying. Like he's gonna get he kind of have a certain certainty on the rewards. There's no uncertainty, and therefore you need to keep a buffer in case the pool actually don't win the reward or have bad luck, to be able to pay him even if he doesn't get the block, right?
Exactly. Spot on. So to the lottery example, we can assign an expected value to each lottery ticket. In a simple example, let's assume that a lottery is worth $10 and there's 10 lottery tickets that are competing for that lottery. One ticket has an expected value of $1. It's going to win 1 out of 10 times for $10 and lose 9 out of times for $0. So the expected value is one. What our pool will do is we will go to that lottery ticket owner, and we will purchase that lottery ticket from them at the expected value minus our fee. And so over the long run, we're going to make money as a pool operator, but in the short run, we might buy a ticket that doesn't end up in a lottery. And so we need to be able to weather those periods of bad luck.
Okay, that's interesting. And therefore, so the best scenario, I would say, for everyone, for all the mining pools at least, would be a much higher concentration. So you're like much more secure on the outcome.
Yeah. So the higher the amount of compute power you have, or the higher market share you have, will, from a human time perspective, will help you weather human time periods. It's why I say human time is because the Bitcoin blockchain doesn't work on that path. They work on blocks. So over a certain amount of blocks, you have the same odds, whether you're a big pool or a small pool. But if you have a big pool with high market share, that time period in terms of minutes and hours gets shortened. And so the weathering that from a an hours perspective is easier once you have higher market share.
Okay, but do you see the industry consolidating to have like a lower time period uncertainty?
Yeah, so currently about 98% of blocks are found by the top 10 pools. So there's very, like, the tail end of mining pools is very small today. It's consolidated quite a bit. There's certain features in kind of Bitcoin's governance that will never allow it, or at least allow it successfully, to become an oligopoly. For example, in the past, a mining pool called ghash.io reached a market share above 40%. The Bitcoin community was very nervous of one player controlling so much market share in terms of block building and consensus, and so they self reduce their hash rate. I think there's this function where people are willing to join a mining pool until it gets to a certain size. That sweet spot seems to be around 30%, but we won't see a space where there's only two mining pools. At that point, the Bitcoin experiment will have unfortunately, to a degree, failed in terms of centralized behavior on block building and consensus. So I foresee kind of us staying at a reasonable amount of mining pools in the space. Roughly 10 mining pools, I think, will be kind of the go to here.
Okay, interesting. So, and what kind of growth have you seen in the mining pool space? Like, as the average mining pool operator, what kind of growth have he seen? Because he gets rewarded the percentage of the rewards, and therefore he has to put in front of it a certain capital. So what's like the return on capital when you compare your fees to the amount of capital you have to put in case of contingency, you don't get lucky, etc., like we discussed?
The mining pool competition is a zero sum game. So if the measure of success in mining pool space is to increase your market share, how much hash rate do you have on your pool divided by the total network hash rate? And so any gain in market share comes at the expense of somebody losing market share. So the market share and success of mining pools since 2011 have kind of ebbed and flowed as new competitors come to market and have their own offering. In terms of return, I think in this environment that we face today, mining pool fees have been compressed a lot in the past few years. They used to be normalized around 2 to 4% of block reward, whereas now they're come down to probably average around 1 to 1.2%, being much lower for institutional large companies, and then retail pays a higher percentage fee. So from a standalone basis, the mining pool is not a good return on capital. And I think a lot of mining pools have realized that in the past few years, and Luxor certainly has as well, and kind of raced to leverage it to build other product lines. What the mining pool
Okay,
really is it's
yeah, but I mean, if I understand correct, you're getting like let's say 2%, And your contingency capital is like 100, and
Yep.
therefore you're making 2% every 10 minutes, no?
So you're making 2% of a much smaller amount every 10 minutes. Well, for example, like if your pool mines 1 block a day, you're getting paid 6.5 BTC. And so you get paid 2%, let's call it, on 6.5 Bitcoin. And that's your return
Okay.
for that day. So um, yeah, it's not the most lucrative business, especially when you start thinking in liquidity, which is I think why not a lot of companies race into this space. The pool is really valuable as an ecosystem. We act as kind of a central hub for well, we operate with 3,000 mining companies, but those are companies that we can also add value to in other ways, such as firmware, ASIC trading, Hashrate Derivatives, data services. So the standalone pool, mining pool, is not kind of a future business model that will be successful. It has to be part of a broader ecosystem that offers software and services to those miners.
Okay, and the software and services that you offer is mining machines, mining software, and derivatives. This one is quite interesting because I think you're the only one offering it, and you went under our radar because Millennium has a strong derivatives background. So, can you tell us a little bit more about these hash rate derivatives that you launched?
Yeah, so this has been a kind of work in progress for coming up on 4 years now that we've been planning this. We wanted to create tools where miners could leverage it to reduce the volatility of their future reward. We saw miners as commodity producers, similar to a farmer, oil or an oil and gas producer, where they're investing capital expenditure today, and they don't know how much the revenue from their capex is going to generate in 3, 6, 9 months in the future. It's an uncertain amount that they'll generate from that hash rate. And so we believe that financial tools will come to the space that allow the commodity producers to get more revenue certainty. And so currently we have two hash rate forward contracts. Fundamentally, what these forward contracts do is two parties come together, they agree on a price for the future commodity, a duration, and a size, and then lock that in. It allows the miner to transfer the risk of future price of hash rate to the buyer, and the buyer to speculate on it. It's an incredibly volatile asset. It's in many cases twice as volatile as the price of WTI oil, much more volatile than gold and some other commodities we look at. So that's kind of led the
How is
industry
it
to
compared
continuously.
to Bitcoin in terms of volatility?
It is slightly reduced. I think it's a few percent lower in volatility to Bitcoin. Um, Mainly a factor of the network difficulty being somewhat of an offset for Bitcoin price, but it's still relatively volatile.
Why would one prefer to speculate on a forward hash price compared to just speculating on Bitcoin itself?
Yeah. So from a trader's perspective, I mean, this industry is still nascent. So that answer might change in a year's time once these products have developed more to market. But I think there's a few very interesting dynamics that go into hash price, what we call the value of hash rate, rather than just Bitcoin price. There's things such as geopolitical events. Do you believe that the tariff from China to the U.S. will increase, or the Taiwan-China situation will impact TSMC's production? Climate events, such as do you think there's going to be heat waves in Texas this summer that will contribute to miners going down, or surges in power prices that will put them, more incentivize them to put power back into the grid. So there's a lot of other interesting dynamics that some traders and prop traders, hedge funds, family offices feel like they have an information advantage or competitive advantage on. They can start trading on this and get a better view than the market. At the same time, because this market is so nascent, there's a lot of price inefficiencies. And so there's a lot of room for market makers and traders to come in and earn alpha right now.
Okay, interesting because you mentioned the commodity space, but I haven't seen in the commodity space any commodity difficulty contracts, like how hard it is to mine gold or to mine oil. Usually it's only in the price that you see all these derivatives and these products. How come in
Yeah.
Bitcoin you have like both derivatives on the spot price and on the hash rate, which is like the computing power?
So we only offer it on the price of hash rate, which is denominated in the amount of dollars that a terahash produces in a daytime or a petahash. So unit of account being dollars or Bitcoin, and then the amount of compute power by the time period. So in many ways, it's structured like an electricity contract in that sense because it's a continuous delivery. But we feel like that's a better way to hedge your risk as a miner than just purely network difficulty. Network difficulty is a major component in that, but the other factors that go into play are transaction fees, so people paying to use the network, block subsidy, which has a fixed schedule but changes roughly every 4 years with the halving, and then finally like USD to BTC exchange rate. So for miners to truly hedge their operations, they need to hedge on the dollars that each unit of compute generates over a period of time. There are some kind of more niche products that trade on just certain factors that go into it, but it's not a complete hedge.
Okay, I got it. I got it. And I asked this question to all the Bitcoin miners, and I am interested to know your answer as a mining pool operator. How do you manage a business that is based on Bitcoin with all the volatility that comes with it, and therefore all the revenue volatility and the balance sheet volatility? It must be nerve wracking just managing it. How how one entrepreneur survives building a business on Bitcoin?
It's not easy, that's for sure. I think breaking it down, treasury management probably top of mind. Um, so what do I mean by treasury management? Well, aligning yourself to weather that volatility, um, having enough run rate to pay your employees, to pay your USD fixed expenses on your balance sheet is very important. Um, at the same time, hedging out some of that as well. And so when we look at kind of capitalizing balance sheet, you want to do it in a few different ways and not go too heavy on a certain way. But I think it's very important to have a cash flowing business during most periods of the cycle and make sure you're accumulating that excess cash flow on your balance sheet. During cycles that are hot in bull markets, raising equity capital. Of course, people raise that in bear markets too, but that was a form of capital that is quite expensive in a bear market. And then finally, being very smart with debt. I think that was the big lesson from the previous cycle is people lean too heavy onto the debt side, whether that was asset-backed financing through ASICs or senior secured debt, other forms. People went too debt heavy, and when you add that much leverage to your capital structure, it really exposes you on the Bitcoin volatility price and the ups and downs of mining economics. So I think the way Luxor's approached it is we've gone very light on debt thus far, and we recommend most of our partners only use debt to kind of complement equity raises and make sure that you're kind of keeping a good like debt to equity ratio and debt coverage ratios as well, because that piece is the most dangerous in terms of weathering the volatility of Bitcoin.
Yeah, this is like from a financial perspective, but what about like from a personal perspective? I see a lot of Buddha heads behind you. Maybe you have to do meditation or stuff because it's not easy, to forecast yourself into the future because you believe in the technology, obviously, and the potential, but at the same time, not getting too excited and like managing it as a very traditional business and not taking too much risk. So how do you balance like personally between these two?
I've seen it like a number of participants in the industry look at a single cycle of Bitcoin mining as a way to get rich. You know, publicly, somebody like Merrick at Marathon had a very fast entry and exit, made a ton of money off of it, and left. Um, that is okay if you can time the cycle well, which is very hard to do. But for the rest of the people, including myself, that want to be here for a decade plus in this industry, I think you have to have, a very deep philosophical tie to the industry we're working on. If you don't have that kind of motivation to contribute to the Bitcoin network, and you're not aligned with what Bitcoin is trying to improve on in society, I think it's hard to get out of your bed every day and deal with all of the challenges that come with this mining space and the craziness that's involved. So that piece is important. And then from like a personal perspective, I mean, to me, like team is everything. Who is working with you? Who's in the trenches with you every day? Do you enjoy working with those people? Do they motivate you, make you to be a better person? If that's the case, it's easy to deal with all of the excess, externalities that come with the space and the harm. But yeah, choosing the right co-founders, building out a great team that you enjoy working with, and then as manager, incentivizing those people to stay, because they may not share the exact same passion as you do for the space, but you want to make sure that the incentive mechanisms are in place for them to see this as a long-term way to build their career and have fun and contribute to society and the company. So that's been an ongoing learning curve for me. I'm a first-time manager. Our team's now 63 people, so it's been a fun journey, but I have much more to learn.
Okay, interesting. And apart from the personal side, how do you tackle the capital raise side? Looking at convincing investors and VCs and pitching them uh, your business. I don't know how the space is big for the private equity side of things. How was your journey on this side, and what kind of investors you were able to attract building your company?
Yeah, so our story is a little bit different than a typical mining company because we come at it from the software side, different business model. Um, in 2017, we bootstrapped the company with around 40 to 50,000. And so it wasn't a lot of upfront initial investment for us to get off the ground running. We got very fortunate, but I kind of use this as a roadmap for some other entrepreneurs in the space that I talk to. Is our first business being the mining pool. We started launching altcoin mining pools. Our first one went live in January 2018. Started immediately cash flowing, and that was a very important way for us to build our company because it took away pressure for us to continuously go to VCs, raise capital, have a 2 year run rate before we run out of cash and have to raise again. So I recommend a lot of people in the space start with a business model that has been proven. There's already market adoption for. And so the risk that you're taking as a new business entering the space is operational risk and execution. You know the market exists, but you now need to find a way to compete and gain market share. From there, it becomes a lot easier. So in late 2020, we ended up raising our first round. It was a pre-seed investment round structured as a safe agreement. So that safe agreement is, an agreement for future equity. It comes with a valuation cap and or a discount to the next round. We got in a lot of mining companies such as Argo and some others into that round. And then 3 months later, we raised our Series A. That was a $5 million Series A led by NIDIG with participation from 21 different mining companies that also kind of joined that round. So we've always been very believers in the idea of bringing other mining companies into our cap table, then doing vice versa later down the road as we invest as well. It's been a tough journey, I think, fundraising. Learned a lot of hard lessons. I personally fundraised in very tough market environments like March 2020 with COVID shutting everything down, Bitcoin price hitting 3.5K, and the halving looming, where investors basically laughed us out of the room, all the way to March 2021, where money was raining from the sky and we had to turn investors down. So, unfortunately, a lot of the success of fundraising is based on market timing and investor sentiment.
Okay, and from my understanding, you invest also yourself in Bitcoin companies. Can you share with us a little bit what do you look at, what you have invested in, and what do you think the future companies that are going to market will look like?
Yeah, so we've made a number of investments in private mining companies. Private mining companies have an interesting journey where they have to find a differentiating factor to them in order to tell a good story. A lot of the time, that differentiating factor has to come down to their access to power. Do they have a unique opportunity to access well-priced power and a good pipeline of it? And that's usually like the determining factor, complemented by the management team. So we look for strong business models that have that differentiating factor that we feel like can go from a small scale private miner to one day getting liquidity on our investments and going public or getting sold through M&A. We've invested in low cost operators in Texas, such as Cormant, ACDC, Mockingbird Mining. We've invested in some software service platforms like Blockware Solutions and a number of other mining companies. So typically, what we do is we'll interface a mining company looking to raise a round. We'll provide some advice on their round, and then make introductions to some of our network. Some of the investors kind of we've co-invested with, for example, ACDC, that round was led by Galaxy. So we like to bring in and work with some of our partners in the mining space. DPO round was led by NIDIG, which is also our Series A investor. So we try to be helpful in fundraising for these mining companies and help them find additional investors too as they scale up.
Okay, so everything you described is very US focused. How do you see like the whole geopolitics going around Bitcoin and Bitcoin mining, especially in Africa, where we have seen recently a lot of promising projects? Have you been following this space, looking at it, or thinking of investing in it?
Yeah, so we've been spending a lot of time in the Africa region as of this year. I think it's still very early on. In many ways, it looks like what Latin America was 3, 4 years ago. So a lot of growth potential and still not a lot of deployment in the space. Geopolitically, definitely is quite interesting and navigating the regulatory and government landscape down there. Um, I think the advantage lies to investment companies coming out of China that are a bit more comfortable working in the region and doing business the way in which a lot of those countries operate in. We're starting to see a lot of Chinese miners set up in the Eastern African corridor, countries like Ethiopia, Kenya, Uganda, Zambia, Angola, um, and then starting to look at some Western African countries as well. But the Chinese miners are very, very comfortable investing in the region, something that I think European and American investors are still a little bit hesitant on, but are starting to get warmer on. So we're trying to actively support the industry and help work with entrepreneurs across those countries.
One thing I learned, like following the whole Bitcoin industry, is all the problems actually the power industry has, because it made me discover that power production and distribution is not efficient at all, even in like the most developed countries. When you mention Africa, I would imagine like even higher inefficiencies and difficulty to make business there. How come Chinese companies are comfortable going there when the power production in general is such a complicated business and such a regulated business, and you have so many mixes of politics and regulation and uncertainties around your investment outcome?
Yeah, I have views here. I don't know if they're 100% accurate because I'm not sitting in their shoes, but I think from my perspective, there's a lot of capital investment going into Africa from China right now through the One Belt One Road initiative, largely ending up in large scale infrastructure projects, roads, ports, hotels, obviously energy grids. And so a lot of Chinese entrepreneurs, business leaders, and government officials are in Africa right now leading this build out. And so in many ways, I think miners are more comfortable investing in countries where they can see their fellow citizens from China also there building roads, building the electricity stations, and they're working directly with them on some of these projects. So I think they feel comfortable that they're protected by the Chinese government and the Chinese industry. And in many ways, I do think they are. Where Africa is very leaning heavily into capital coming from China and does not want to mess that up and get in the way of that capital inflow. So I think they feel protected. But on the electricity grid perspective, most of Africa is under electrified, meaning a lot of citizens in these countries do not have access to electricity. And so that definitely is the goal of a lot of these companies that are building hydroelectric dams and natural gas plants around Africa is to get it to the people. Where I think a lot of the shortcomings is happening and the opportunity for mining is the transmission and distribution build out is very expensive and it's very hard to do. And so miners are coming in and offering a use case or a demand for electricity right at the source of electricity production or right next to a substation. And so, for example, Ethiopia has about 4 gigawatts worth of power production, yet only 2 gigawatts is being used by the people. 2 gigawatts is basically stranded. And so miners can come in, take a few hundred megawatts at source, and the electricity grids and power producers can use that funding as a way to build transmission distribution for the remainder. And so I think the Chinese are kind of leveraging that type of challenge right now and seeing it as an opportunity for them to come in and build out mining farms.
Okay. Okay. Perhaps one last question about regulation. There's been a lot of the past year, I would say, there's been a lot of evolution on the regulatory side, whether it's in Europe or the US, and the whole crypto space in general. We also have seen the first presidential candidates owning Bitcoin, which is a massive evolution from the previous political space. How do you see Bitcoin regulation and the evolution of this regulation going on forward? Because we've seen like a lot of mixed signals from Europe to the US, where you have like a lot of pro voices and at the same time a lot of anti voices, and CBDC is being pushed in and being talked about more and more as a better alternative. I don't think it is, but this is what the narrative is. How do you see this evolving in the future?
I think there's some jurisdictions, such as the Chinas of the world, where it might be a bit futile to spend resources trying to advocate on behalf of the Bitcoin mining industry. And there's obviously a successful transition of miners away from that jurisdiction when they did ban Bitcoin mining. But at the same time, we can't just, as a mining community, jump from one country to another based on regulation. I think it's our job as miners to be at the forefront of this and making sure that we're advocating for mining in the jurisdictions that we operate and not giving up ground. It's probably going to be a tug of war moving forward in almost every jurisdiction. So, focusing on North America, some of the states have been extremely hostile towards Bitcoin mining. Washington State, Quebec in Canada, British Columbia in Canada, Manitoba, and now New York as well. So there's certain kind of sub jurisdiction states or provinces that I think are going to continue to be hostile to Bitcoin mining. Those leaders of those jurisdictions, I feel, are a little bit conservationist when it comes to energy production, and they look at energy production as basically something they should reduce, which will always kind of not fit the narrative of, okay, we want to actually produce more energy as a civilization. And then you'll have some states that are very supportive, like the pro-business states of Alberta and Canada, Texas, Kentucky, and Ohio. So on the state level, I think it'll be, up to kind of the philosophical leanings of the government and the advocacy work that we do there as a community. On the federal levels, I think that's where a lot of the time needs to be spent educating lawmakers on the benefits of Bitcoin mining and what it brings to their jurisdiction. So there's a lot of great advocacy groups working across the United States and Canada that are working hand in hand with politicians, trying to orange pill them, trying to get them to understand what Bitcoin mining means to increase the resiliency of electricity grids and incentivize the development of new renewable greenfield energy projects. So I guess long way of saying it's a tug of war that we're all a part of.
Yeah, but you pinpointed some stuff that I want to raise a little bit deeper. If we look at Bitcoin mining as an electricity consumer, there are some benefits, which is monetizing stranded energy, like you described in Ethiopia, or balancing the grid, especially if you want to deploy a bigger renewable network and make more investments into energy production. But at the same time, you have all the negative effects, like increasing the electricity bill because you have more consumption, or creating power shortages because they're draining all the electricity from one city or one state because they became too big. What would be the ideal regulation for a state, city, country to have a perfect osmosis with Bitcoin miners?
Yeah, so I think laying the infrastructure for that discussion is jurisdictions should be energy production focused, meaning everyone should have a 20, 30, 40-year roadmap on how does that state or that province produce more power in the future, whether that's through nuclear, hydroelectric, whatever the local power sources may be. Of course, not every jurisdiction has the ability to have great power sources. If you look at an island in the Bahamas, obviously their options are quite limited relative to a province like Quebec. But I think everyone should be kind of thinking about, okay, how do I produce more energy as an economy, and how do I support more energy consumers in the future? Because it won't only be Bitcoin miners, but it's also going to be a massive wave of data centers and other forms of compute that need this electricity. In terms of Bitcoin miners' place in the system, I think you need a very fair market system for bidding up that electricity and seeing where the demand goes to. Ultimately, civilians that are using the electricity for heating their homes in the wintertime or air conditioning in the summer, they will always be willing to pay a higher price than Bitcoin miners will be. Bitcoin miners in this current dynamic, especially heading into the halving, they're not going to be setting up shop in jurisdictions that cost more than 6 cents a kilowatt hour as base case electricity price. And so there's this, as long as you have a good free market system, I don't think there's any risk to Bitcoin miners coming in and consuming power that should be going to civilians, because Bitcoin miners are much more price sensitive. They'll get priced out of the market by uh, I guess higher use cases per kilowatt hour of what people are willing to pay for. So I think there's examples of times in which there was bad actors in Bitcoin mining and potentially corrupt government officials. But assuming no corruption, fair market environment, I think it's usually a net positive for every community to at least have the option for Bitcoin miners to come in and compete for electricity.
So if you take out illegal actors or bad actors, the whole market will regulate itself because Bitcoin miners will not pay a very high electricity price anyway, so they will never be competing with all the other electricity consumers. That's your point.
I think fundamentally they won't be able to outcompete them on the high valuable use cases of electricity, but they certainly will increase demand, which hopefully should incentivize the development of new energy belts. Over time, I'm of the belief that human civilization should consume more electricity and produce a lot more, hopefully in a very clean and renewable manner. That is, properly accounting for externalities such as climate change and pollution. But over time, we should be striving for the development of more and more, especially renewable energy projects. So while there might be some short term impact on increasing price as a function of increased demand, I think long term it incentivizes the right metrics, which is producing more power. And any regulations that come about on the kind of ESG narrative, I think need to be thought through very, very carefully by regulators, and should be more fundamentally geared towards the industry as a whole. So it doesn't really make sense to allow a certain user of coal to mine, using coal for, say, video rendering, but not use it per SHA-256 algorithm. You start getting into very slippery slopes there, telling people what they can and cannot use the source for. Whereas I think a much more fair system is just to regulate, say, like the coal industry, as a lot of jurisdictions have been doing.
Okay, interesting. Well, thanks you very much for sharing all these insights, and I was very happy to have you on the show. And I look forward to have you again once you have anything new coming to sharing it with us.
Right on. Well, thank you so much for having me. It was a great discussion.